Welcome to the Deep Dive, where we take a monumental stack of research, academic papers, and historical insights, and we distill them into the most potent knowledge transfer available.
We're giving you the shortcut to being well-informed, not just about what happened, but, why it still matters right now.
And today, we are plunging into the investment world's most enduring and, I think, profoundly influential philosophy, value investing.
It's a system, really. It claims to take the guesswork out of the market.
How so?
The entire paradigm is focused relentlessly on one thing: buying securities that appear underpriced.
But not just based on a hunch or a hot tip.
No, not at all. It's through methodical, rigorous, fundamental analysis, and it's an approach that has produced some of the greatest wealth creators in history.
Okay, let's unpack this immediately. If we establish the bedrock of this whole approach, it all comes down to buying an asset for less than its true underlying worth.
Right, what we call intrinsic value.
And that term, intrinsic value, it can sound a little elusive, can it? Especially in today's fast-moving markets.
It sounds elusive because it's an estimation, but, and this is the key part, it's an estimation based on verifiable facts about the business itself.
So separate from all the emotional noise of the market.
Exactly. Think of it like this. What would a highly rational, fully informed private buyer pay for the entire company today? That's your intrinsic value.
And the discipline isn't just about finding that number.
No.
Yeah.
It's about ensuring you buy with a protective buffer.
Right. That protective buffer being, of course, the famous concept from Benjamin Graham, the margin of safety.
Precisely. The margin of safety is that gap, that discount between the market price and your calculated intrinsic value.
So if you think a stock is worth $100,
and you only pay $60 for it, that $40 difference, that's your margin of safety.
that sounds less like a financial theory and more like a fundamental rule of engineering, which I really appreciate.
It's a perfect analogy.
You always build in more strength than you think you need. It's a protection against, what, a calculation error?
A calculation error, yes, but also against the sheer unpredictability of the future, the world.
Right.
An engineer designs a bridge to handle 100 tons, but they build it to withstand 150. That 50-ton buffer, that's what protects you.
Against what? Poor materials, maybe?
Poor materials, an unexpected traffic load, or just a simple miscalculation in the initial design. In investing, that buffer protects you if the company's earnings are a bit weaker than you projected.
Or if the whole market just goes into a panic because of a recession.
Exactly. It drives all prices down unexpectedly. Your margin of safety is what lets you sleep at night.
And what's truly fascinating to me is that this entire strategy, which has proven itself for nearly a century, is just a direct rejection of one of the dominant theories of academic finance.
Oh, it's the ultimate intellectual conflict.
You're talking about the efficient market hypothesis, right? The EMH.
That's the one. The EMH posits that because all information is instantly available to millions of, hyper-rational traders, all securities are priced perfectly and accurately at all times.
So if the price is $100, the value is $100. There are no deals to be had.
Correct. But the value investor comes along and says,
wait a minute. Human beings run the market.
And human beings are emotional. They're subject to fear and greed and just wild short-term thinking.
So the market isn't always rational.
Exactly. Value investing proposes that the market is often irrational, creating these little windows, these opportunities where securities are, in fact, not accurately priced.
And those moments are caused by what? Panic? Neglect?
All of the above. Panic, neglect, or sometimes just a simple lack of understanding of the underlying business, the ability to spot those temporary mispricings. That's the whole game.
And this movement, this whole philosophy, it didn't start with some flashy hedge fund in the 80s. It started in a classroom.
It did. The foundation was laid at Columbia Business School by Benjamin Graham and David Dodd. This was way back, starting around 1928.
And then it was all formalized in their legendary 1934 text, Security Analysis.
Which is, a dense, rigorous book. It really set the standard for how professional analysts should look at companies.
It's interesting. Our sources are very clear that Graham himself never actually used the phrase value investing.
That's right. It was coined later to describe his ideas.
Which, ironically, might have led to some misinterpretations over the years.
For sure. The simplistic idea that he was just telling people to buy the absolute cheapest stocks they could find, regardless of the quality of the business.
That distinction is so important, and it kind of foreshadows the whole evolution of the strategy we're going to talk about.
It does. So our mission today is to trace this whole intellectual history. We want to understand Graham's rigid foundation, then see how the key figures who came after him adapted it.
People like Warren Buffett and Charlie Munger.
Exactly. And then we'll explore how modern quantitative and technological methods have, well, completely reshaped what it even means to calculate intrinsic value today.
All right, let's dive in.
Let's do it.
Let's dedicate some serious time to the bedrock here in Section 1. The foundational work of Benjamin Graham and David Dodd. They did more than just invent a strategy. They really professionalized the discipline of security analysis.
They did. They separated it from the casino-like speculation that really dominated Wall Street before the Great Depression.
And Graham is absolutely the towering figure here, the father of value investing.
No question. His work survives primarily through two monumental texts. First, as you said, Security Analysis in 1934, which he co-authored with Dodd.
That was the dense one, the professional academic blueprint.
Right. And then his later work, The Intelligent Investor, which took those core concepts and translated them into actionable, accessible principles for the individual investor.
Which is why it's earned a permanent place on, well, pretty much every successful investor's bookshelf.
It really has.
So what was so revolutionary about security analysis at the time? What void did it fill that made it the definitive guide for decades?
Before Graham, Wall Street analysis was often, well, qualitative. It was based on reputation, industry trends, or maybe the charisma of a company's management.
The story.
The story, exactly. Graham's lasting contribution was his intense, almost obsessive emphasis on the quantifiable.
The numbers.
He mandated that analysts focus on things that could be objectively measured and verified. Primarily, that meant reported earnings and book value.
So he was telling people to stop listening to the CEO's promises and start actually reading the financial statements.
Yes.
Treating a stock like a fractional share of a real business, not like a lottery ticket.
That's the perfect way to phrase it. His methodology intentionally minimized those qualitative factors.
Why?
He believed that trying to judge the quality of a management team or guessing the likelihood of success for some new, exciting product launch, it just introduced too much subjectivity, too much speculation.
He wanted cold, hard, verifiable numbers.
Exactly. And in his early years, especially, in the wake of the 1929 crash, he was focused on buying assets that were basically undergoing liquidation.
So he wanted to buy companies for less than their net current asset value.
Right. Essentially treating the stock as if it were worth more dead than alive.
That's what people now call net investing, or deep value. You're buying something for less than its easily liquidated inventory, cash, and receivables after you subtract all the liabilities.
That's the classic, highly conservative Graham approach. And to find those opportunities, he established these very objective, very measurable screening criteria.
And these were designed to filter out the high flyers, the popular stocks.
And instead focus on the neglected, the depressed, or the genuinely misunderstood companies.
Let's walk through that checklist. Because these original criteria are still the starting point for countless systematic strategies today. What was Graham actually telling people to look for in the 1930s?
The screen was highly statistical and very conservative. First, he looked for stocks trading at a significant discount, sometimes 30% or more, to their book value.
Or tangible book value, which is even stricter.
Right. Book value, just to be clear, is the accounting value of assets minus liabilities. Tangible book value then excludes any intangible assets, making it, as you said, even more conservative.
So that ensures you're buying something that has physical, verifiable assets backing up the price.
Precisely. He also favored companies with high dividend yields.
Why dividends specifically?
Well, dividends provided concrete, immediate evidence that the company was profitable and that it was shareholder-friendly. It reduced your reliance on future capital appreciation, which is always uncertain.
Makes sense.
And critically, he looked for low valuation ratios, specifically low price-to-earnings, PE multiples, and low price-to-book PB ratios.
A low PE ratio, that's a pretty clear sign of neglect, right?
Okay.
It suggests the market is currently paying very little for every dollar of the company's earnings.
It is. So his specific, very stringent checklist included a few things. First, purchasing firms that had steady profits over multiple years. Stability was non-negotiable. Second, as we said, they had to be trading at low prices relative to book value. Third, they needed low PE ratios, often in the single digits. And finally, and this was crucial for defense against insolvency, they had to carry relatively low debt.
So it was really a financially conservative filter.
Extremely. It was designed to ensure you were buying a cheap company, but not necessarily a failing one.
Yeah, every single one of those layers, from the steady profits to the low debt, it all serves to enhance that one single most critical concept.
The margin of safety.
It's the ultimate safeguard.
Absolutely. If you adhere strictly to this checklist and you buy a stock well below its calculated intrinsic value, you're creating a buffer. A buffer against the three main threats.
Which are?
Unforeseen poor outcomes, broad market volatility, and just as important, your own analytical error.
And without that buffer?
Without that buffer, Graham argued, you are just engaging in financial speculation. You're not doing disciplined investing. The value investor is willing to be patient, knowing they've bought a dollar bill for 70 cents or maybe even 50 cents, and time is on their side while the market eventually, hopefully, corrects its irrational pricing.
The clarity of Graham's methodology is powerful, but as we move into Section 2, it's clear the core insight that price and value are not always the same thing. It actually predates him by centuries.
Oh, for sure. We need to place Graham in this broader historical context and then see how the definition of value itself had to evolve after his lifetime.
Showing the lineage proves the concept is timeless.
It really is. We can trace the recognition of this price versus value divergence all the way back to the financial markets of the 1600s.
That's astonishing. How far back are we talking in concrete terms?
We can point to the 1690s, and specifically to the famous writer and commentator Daniel Defoe.
The author of Robinson Crusoe.
The very same. He observed the stock of the East India Company trading at what he called a ludicrous price, over 300% more than its face value.
Wow.
And Defoe wrote about how this valuation suggested, and I'm quoting here, no material difference in intrinsic value between the shares being bought for huge sums and those that cost much less.
So he's saying the underlying worth hasn't changed, just the price people are willing to pay for it.
Exactly. It shows that the concept of overpaying for an asset, and thus the idea of a true underlying worth, existed 3 centuries before Graham even started teaching.
That anecdote just grounds the whole discussion, showing that human nature in markets really hasn't changed a bit. So then we jump forward to the Victorian era with someone who has been retrospectively labeled a value investor.
That would be Hetty Green, often called America's first value investor. She lived from 1834 to 1916.
And she was a renowned contrarian.
A legendary one.
Yeah.
Her standard operating procedure was to buy unwanted, often depressed assets. It could be undervalued land, undervalued debt, or stock at extremely low prices.
And then what? Just wait.
And simply hold them until the market changed its mind. She famously said that she kept these assets until they go up in price and people are anxious to buy.
That patience and contrarian focus on a low purchase price. Those are core tenets of the value ethos.
They absolutely are.
And institutionally, we know that there was an investing firm operating at the same time as Graham that followed these exact same principles.
Yes, the firm Tweedy, Brown. It was founded in 1920 and is often described as the oldest value investing firm on Wall Street.
And their founder, a man named Forrest Berwin Bill Tweedy, found a really specific niche.
He did. He focused on buying smaller, often family-owned companies. And because these stocks traded in really low volumes and had fewer buyers, the sellers were often desperate.
Which allowed Tweedy to acquire shares at steep discounts to their book value.
It's a perfect example of capitalizing on market inefficiency caused by illiquidity, a lack of buyers.
And they must have been effective, because the sources note that Tweedy and Graham actually worked in the same building and became friends.
They did. They both operated from 52 Broadway in New York City, and that intellectual exchange between the academic formalizer, Graham, and the highly effective practitioner, Tweedy, was critical to cementing these ideas in the real world.
Now let's discuss the surprising independent developer of very similar ideas, John Maynard Keynes.
Yes.
We usually associate him with macroeconomics, not picking individual stocks.
And Keynes is a profound example of practical learning just trumping abstract theory. While he was managing the endowment of King's College, Cambridge, in the 1920s, he started out with a market timing strategy.
Trying to predict the broad movements of the economy.
And he failed, spectacularly.
So he pivoted. And how did that pivot align with what Graham was thinking?
After he abandoned his failed attempts at market timing, Keynes shifted his focus. He started concentrating on a very small, select number of undervalued stocks that he knew exceptionally well.
So he stopped chasing the big picture macro calls and started doing microvaluation.
That's it. He targeted undervalued stocks, often small and mid-sized companies, and particularly those in industries that were considered, dull or out of favor.
Like mining and autos during the Great Depression.
Exactly. So he switched from trying to time the flow of the entire river to carefully examining the quality of the individual boats floating in it.
And the long-term results were undeniable.
Despite that rough start, his portfolio managed to beat the market averages by an incredible 6% annually over more than 2 decades. It was just confirmation of the power of focused valuation over speculative timing.
And the sources confirm he developed this completely independently of Graham and Dodd.
Yes. The archival review at King's College suggests there's no evidence of collaboration. His theories were developed on his own and weren't widely known until decades after his death in 1946.
But the considerable overlap in terms and concepts, especially the focus on intrinsic value, it suggests the principles are just universally valid.
They are.
Which brings us to the core evolution of the idea, the post-1970s world. Graham's original reliance on book values started to become a major liability as the economy shifted.
This is the critical transition point. Book value assets minus liabilities. It works beautifully when your assets are tangible.
Factories, trucks, inventory, oil reserves.
Exactly. It works a lot less well when the company's primary value resides in its head, not in its physical plant.
We're talking about the rise of technology and service sectors, where the assets are things like patents, brands, copyrights, or management expertise. Intangible assets.
And this creates 2 massive problems for Graham's original framework. First, intangible assets are incredibly difficult to quantify reliably.
And second,
they often won't survive a company breakup. If a manufacturing firm goes bust, you can sell the factory. If a tech firm goes bust, how much is their code or their brand equity worth?
often nothing.
Right. And in fast-changing industries like software or personal computers in the 80s, the value of those assets could suffer permanent impairment almost overnight because of disruptive innovation.
Yesterday's cutting-edge patent is tomorrow's worthless scrap of paper.
Absolutely. So the balance sheet just stops telling the whole story. If we can no longer rely on physical assets to represent intrinsic value, how do we adapt the core principle of valuation to the modern knowledge economy?
And that is the very problem that led to the modern solution.
Which is the discounted cash flow model, or DCF.
Right.
The DCF model shifts the focus entirely from past assets to future earnings potential. The definition of intrinsic value is reformed. It becomes the sum of all future cash flows the business is expected to generate.
Discounted back to the present day to reflect the time value of money and risk.
Exactly. So instead of looking at the factory they built in 1950, you're looking at the revenue stream they will generate until 2050.
This allows you to value those intangible assets, future growth, competitive advantages, all the things that Graham's strict balance sheet rules kind of missed.
It does, but it introduces this new problem of valuation ambiguity, which we'll circle back to.
Because now your valuation is heavily dependent on your own assumptions.
3 major input assumptions: the estimated growth rate of the business, the discount rate you apply to reflect risk, and the terminal value you assign to the business beyond your forecast period.
And if 2 analysts use even slightly different assumptions for those 3 inputs,
they can arrive at wildly different intrinsic values for the very same company.
So the DCF model is a powerful tool, but it also relies on subjective forecasting.
Which makes it the source of so much analytical error and debate today.
That challenging transition from the certainty of the balance sheet to the prediction of cash flows, it leads us perfectly into Section 3, the modern approaches.
Right.
We see the legacy kind of split into 2 major methodologies: the systematic, which uses technology to run Graham's screens, and the qualitative, which uses human judgment to refine the definition of quality.
Let's start with quantitative value investing.
Okay.
Quantitative or systematic value investing is basically Graham's objective, rules-based approach, but supercharged by modern computing power.
So it involves rigorously analyzing massive data sets.
Financial statement line items, economic metrics, even unstructured data like news reports, all to systematically screen for undervalued traits.
This sounds like a direct attack on human error.
Right.
We're using statistical finance, machine learning, behavioral finance, all to find undervalued stocks.
That's the core mission. Quantitative investing seeks to replace that slow, ad hoc, stock-by-stock analysis done by a human with a massive, data-driven system.
And the goal is to eliminate cognitive biases.
Exactly. Humans are notoriously bad at objectivity. We suffer from confirmation bias, recency bias, anchoring. A rules-based system executed by a computer doesn't get greedy or fearful or emotionally attached to a stock.
It's interesting that Graham himself seemed to acknowledge the need for this kind of systemization a long, long time ago.
He did. Later in his life, Graham admitted that relying on detailed, individual financial analysis of single stocks was probably unlikely to produce superior risk-adjusted returns consistently.
So what did he recommend instead?
He advocated for a rules-based approach, one focused on constructing a well-diversified portfolio using objective financial factors. The quantitative movement is simply realizing his ultimate conclusion, but with far superior technology.
Can we look at some real-world examples of how this quantitative screening works, maybe even in its simplest forms?
Sure, we can start with Joel Greenblatt's famous magic formula investing. It's a highly simplified illustration, but it gets the point across.
Okay.
It systematically ranks and buys companies based on just two simple factors: earnings yield and return on invested capital.
So the idea is to buy good companies at cheap prices, systematically.
That's it. It's a very easy to understand filter. But more sophisticated modern practitioners, they evaluate dozens, even hundreds of metrics at the same time.
And a key text in this field is James O'Shaughnessy's What Works on Wall Street.
A classic. It provides comprehensive backtesting of all these different quantitative value strategies with data spanning from 1927 all the way through 2009.
And what did he find?
These studies confirm that simple value factors, when you apply them consistently and systematically across large pools of data, they tend to outperform over long time frames.
So that's the systematic, data-driven path. Now let's pivot to the other evolution, the qualitative shift driven by Graham's most famous disciples, Warren Buffett and Charlie Munger.
This is perhaps the more publicly recognizable face of modern value investing.
For sure.
And it represents a pivotal moment where Graham's initial rigidity, that focus on statistically cheap cigar butts that had one last puff left in them, was abandoned in favor of quality.
Buffett credits his initial success to Graham, but the philosophy evolved dramatically when Charlie Munger became a key partner at Berkshire Hathaway in the 1970s.
Munger famously focused on the non-quantifiable elements. He looked for companies with qualities that ensured long-term durability even if the stock wasn't statistically dirt cheap. Munger forced Buffett to ask a much harder question. Why buy a stock that's 50% below its intrinsic value if that intrinsic value is eroding rapidly because of competitive pressure or, obsolescence?
Better to pay a fair price for something whose value is growing.
Exactly. Munger emphasized companies with robust qualitative qualities, sustainable competitive advantages, or a moat, as Buffett calls it, and long-term growth potential. They sought businesses that could compound value over decades.
This influence caused Buffett to fundamentally reduce his emphasis on just those statistically cheap assets. He recognized that cheap often just means structurally impaired.
The cheap price often turns out to be a value trap. The price is low because the business is bad or it's getting worse, meaning the intrinsic value you calculated is actually on its way to zero.
And this shift was all crystallized in one of the most quoted sentences in investment history.
Warren Buffett's updated philosophy. It's better to buy a great company at a fair price than a fair company at a great price.
And that one statement completely redefined value investing.
It did. It emphasized that quality and durability are themselves components of the margin of safety because they secure those future cash flows.
It connects right back to the DCF model we were talking about. The growth component matters immensely. You want a company whose future cash flows are highly predictable and durable.
Exactly. And beyond the analysis, the source material notes that perhaps the most valuable component shared by all successful value investors is simple temperament.
Meaning emotional stability in the face of market mania.
That's it. Buffett recognizes that markets are driven by emotional extremes, fear and greed, which is what creates the mispricings in the first place.
And his famous advice is the guide to that temperament.
Be greedy when others are fearful and fearful when others are greedy. And that requires incredible emotional stability and patience. It enables the value investor to stick rigorously to their intrinsic value calculation even when everyone else is panicking and dumping the stock.
Or conversely, getting euphoric and bidding the price up to totally unsustainable levels.
It's the key to the whole thing.
That sense of disciplined temperament and patience is the thread that runs through Section 4, the pantheon of value investors. This is not just a list of names, it's an intellectual lineage.
Right. It traces how Graham's principles were put into practice across different decades and different market cycles.
It's the super investors of Graham and Doddsville roster, showing the direct output of that one Columbia classroom.
And the immediate lineage of Graham's teaching assistants and employees is just profound. Let's start with those who work directly alongside the master.
Okay.
We can begin with Irving Kahn, who served as one of Graham's teaching assistants back in the 1930s. Kahn was a decades-long friend and a close contributor.
He actually provided research for both security analysis and the intelligent investor.
He did. He later co-founded Kahn Brothers and Company, a dedicated value investing firm, and remained its chairman until his death at the remarkable age of 109.
Wow.
That longevity is a testament to the safety that's inherent in the methodology.
And then there's Walter Schloss, who is maybe the definition of the self-made, strict Graham disciple.
Schloss is the quintessential deep value investor. He started as a runner on Wall Street, attended Graham's night courses, and then worked at the legendary Graham-Newman partnership.
And he strictly adhered to Graham's statistical approach, right? He prioritized low prices over any qualitative factors.
Absolutely. He ran his own firm for nearly 50 years and was featured prominently by Buffett in his 1984 speech, confirming that Schloss's success was achieved simply by buying statistically cheap stocks and being incredibly patient.
The sources also highlight the firm that Graham himself preferred to use.
That would be Tweedy, Brown, the oldest firm we mentioned earlier. Christopher H. Brown, who ran the firm for years, was deeply committed to Graham's principles.
The Wall Street Journal confirmed Tweedy. Brown was Benjamin Graham's favorite brokerage firm.
That's right. And Brown also wrote the Little Book of Value Investing, ensuring the ideas remained accessible to new generations. Their funds have a long, documented history of beating the market averages.
Now, moving internationally, we had Peter Cundall, who applied these strict principles to the Canadian market.
Cundall was a highly respected Canadian value investor who maintained Graham's stringent criteria. His Cundall Value Fund gave Canadian investors access to this methodology.
And he got high praise from Buffett himself.
He did. Warren Buffett indicated that Cundall had the credentials and the approach that Buffett looked for in a chief investment officer. That's about as high praise as you can get.
For a modern example that really captures the drama of the margin of safety, we have to talk about Michael Burry.
Of course. Burry, the founder of Scion Capital, cemented his fame by being one of the first investors to recognize the systemic failure brewing in the subprime mortgage market.
Famously featured in The Big Short.
Right. And his approach, which involved incredibly deep analysis and a focus on massive downside protection, was rooted entirely in Graham's text. Burry has explicitly stated that his investment style is 100% based on the concept of a margin of safety from security analysis.
He's a living example of how the principles can be applied to complex, modern financial products.
He really is.
And the academic lineage at Columbia didn't just stop when Graham retired. It continued through the professors who came after him.
The school became an intellectual factory for value managers. Graham taught Buffett from 54 to 56. 2 decades later, a professor named Roger Murray was teaching value investing to future superstars like Mario Gabelli.
And later, Bruce Greenwald arrived.
Greenwald became a leading contemporary voice, producing his own protégés like Paul Sonkin. Columbia Business School's enduring emphasis on this valuation methodology really makes it a central node for this school of thought globally.
Let's look at the other major lineage, the one that stems from the mutual series funds.
This tradition began with Max Heine, who founded the Mutual Shares Fund way back in 1949. Heine's great success was then continued by his protege, the legendary value investor Michael F. Price.
Price was known for his aggressive activism and forensic accounting.
Yes, often focusing on distressed securities and complex restructurings to maximize shareholder value. Even after Mutual Series was sold to Franklin Templeton in '96, the disciples of Heine and Price carried on that tradition of deep, contrarian, event-driven value investing.
And one of those Mutual Series alumni wrote a book that has become this rare, highly sought-after classic.
That is Seth Klarman, an alum of Mutual Series and the founder and president of the Baupost Group.
And the book is Margin of Safety: Risk-Averse Investing Strategies for the Thoughtful Investor.
Right. And because it's out of print, copies have become investment classics themselves. They often sell for well over $1,000 used.
Wow. And why is the book so revered?
Because Klarman's philosophy emphasizes the preservation of capital above all else. He ensures that the margin of safety concept is applied not just to valuation, but to every aspect of portfolio management.
Beyond these strict lineages, the sources highlight several other notable investors whose methods, while distinct, still orbit that core value principle.
Right, like Lawrence Tisch, who led Lowe's Corporation for over 5 decades. Fortune magazine famously described him as the ultimate value investor and a brilliant contrarian who saw value where others missed it.
Often investing in deep, cyclical businesses during periods of maximum pessimism.
And Lowe's Corporation has demonstrated the long-term effectiveness of that patience. By 2012, they had reached over $14 billion in revenues and assets, over $75 billion.
Then we have someone who manages one of the world's largest pools of private capital,
That would be Michael Larson, the Chief Investment Officer for Cascade Investment.
which manages the personal fortune of Bill Gates and the Bill and Melinda Gates Foundation Endowment.
Larson is a highly private value investor, known for disciplined, long-term asset selection. And though his specific strategies are confidential, his firm has consistently rivaled or even outperformed Berkshire Hathaway's returns.
Which proves the methods work even when you're managing immense pools of wealth.
It does.
Let's discuss Martin J. Whitman, whose approach is highly defensive and, well, almost entirely dismissive of macro forecasting.
Whitman's strategy is called safe and cheap, or the financial integrity approach. He focuses relentlessly on acquiring common shares of companies that possess extremely strong financial positions.
So low debt, high liquidity.
Exactly. And at a meaningful discount to their estimated net asset value, or NAV. His philosophy asserts that it's generally futile to pay attention to macro factors like GDP or interest rates,
Right.
because attempts to predict their movements are usually wrong, and they just distract the investor from the hard work of actually valuing the specific business in front of them.
That must simplify the process dramatically. Just ignore the noise, focus solely on the company's balance sheet strength.
Precisely. Now, we can circle back to Joel Greenblatt, who we mentioned earlier. He's known not just for his simple quantitative formula, but for specializing in specific types of market confusion.
Special situations, right?
Yes. Greenblatt achieved over 50% annual returns for a decade at Gotham Capital by focusing on these special situations.
Things like spin-offs, mergers, asset sales.
Right. Events that often create temporary uncertainty or require complex legal understanding, causing the broader market to undervalue the components or the newly independent company. Greenblatt specialized in understanding the mechanics of these events to capture the value that was unlocked.
Finally, we have to emphasize the strict financial discipline taught by the global value managers Charles DeVol and Jean-Marie Eviard.
They are famed global value managers known for achieving outstanding risk-adjusted outperformance over decades. And their non-negotiable principle goes right back to temperament and patience.
Which is?
Investors should never use margin or leverage.
And why is this such a fundamental rule for them? They label the use of leverage as outright speculation.
Because value investing is predicated on patience. You're waiting for the market price to converge with your calculation of intrinsic value. Leverage, or using borrowed money, introduces a mandatory timeline. If you use leverage and the stock price moves against you, your lender can issue a margin call, forcing you to liquidate at the worst possible time. It completely compromises your ability to be patient.
It turns a long-term investment into a short-term trade based on timing.
And by eliminating leverage, you secure your ability to hold that dollar you bought for 50 cents until the market finally agrees with your assessment.
That separation between disciplined analysis and forced speculation sets the stage perfectly for our final section, Section 5. The historical record is compelling, the disciples are legendary, but we need to address the hard performance data, the modern metrics required, and the persistent legitimate criticisms of this strategy.
And if we look at the evidence of value performance, the academic research is remarkably consistent, especially when you track simple strategies over decades.
And what does that consistency show?
Numerous studies have consistently found that value stocks, so those defined by low PE or low PB ratios, they outperform growth stocks and the overall market index when tracked over long periods.
And some of this analysis goes all the way back to the 19th century.
It does. This isn't a short-term fad. It appears to be a systemic market anomaly.
Is this overperformance uniform across the market, though? Do mega-cap value stocks outperform just as well as the smaller ones?
That's a key nuance. A review of U.S. market data from 1990 to 2015 found that the overperformance of value was significantly more pronounced in stocks for smaller and mid-sized companies than for the large, widely followed companies.
So the market inefficiencies are more frequent and dramatic outside of the intensely scrutinized S&P 500 giants.
Naturally. And of course, the real-world confirmation came from Buffett's famous speech, where he profiled the results of Graham's disciples.
Right, confirming that buying businesses below intrinsic value is a sustainable long-term road to success.
The track record of those super investors proved the methodology works. But we have to confront the critics, because value stocks do not always beat growth stocks.
The late 1990s tech bubble is the classic example. Value lagged dramatically while growth soared for years.
It did. And this leads to the fundamental question that academic finance poses. If value consistently outperforms over time, why isn't the market technically efficient? And if it is, what explains the outperformance?
So what's the dominant academic criticism?
It's known as the risk-based explanation. It argues that the outperformance of value doesn't imply market inefficiency. It might simply mean that value stocks are inherently riskier.
How so?
Well, perhaps because they're smaller, more indebted, or facing more structural headwinds, and so they require a greater return premium to compensate investors for bearing that extra risk.
So essentially, you're just getting paid extra to hold what is statistically more likely to fail.
That's the argument. And furthermore, research by Foye and Miramore in 2016 suggested that the factors leading to value stock outperformance might be heavily country-specific, which complicates applying a universal value factor model globally.
And here's the core practical criticism that every value investor has to face: the risk in relying purely on low prices, the value trap problem.
This is critical, especially for the retail investor who is just relying on simple screens like a low PB ratio. Price-centric value investing often leads people to misinterpret the data. How? A stock trading at a depressed price is frequently depressed for a very sound structural reason, a fundamentally negative difference or a permanent change in the company's financial health or competitive standing.
They screened for cheap and they just got junk.
They bought the value equivalent of a broken-down car. They completely missed Buffett's refined philosophy. You must have a qualitative margin of safety.
So to address this specific problem, how to separate the genuinely neglected value stocks from the cheap, failing ones, a significant quantitative solution emerged from academia.
And that would be the Piotrowski F-score.
Right. Tell us about that.
It was developed by a Stanford accounting professor, Joseph Piotrowski, in 2000. The F-score is a rigorous quantitative tool designed to discriminate between higher and lower potential members within a class of already identified value candidates.
So you use it after the initial simple screening.
Exactly. After you've identified stocks with, say, a high book-to-market ratio.
So once you have your list of cheap stocks, how does the F-score function to refine it?
The F-score is a 9-point scale. It awards 1 point for each positive signal found in a firm's annual financial statements.
And what are those signals looking for?
These 9 checks cover 3 crucial areas of financial health: profitability, like a positive return on assets; leverage and liquidity, like a decrease in leverage; and operating efficiency, like an increase in asset turnover.
So it's basically a health check focused on whether the cheap company is improving or deteriorating.
Which is vital. And Piotrowski retrospectively demonstrated the power of this health check using data from 1976 to 1996. He showed that high F-score selections within that cheap group increased returns by 7.5% annually.
Compared to the cheap class as a whole.
Right. That is a massive lift in performance just by adding a layer of financial diligence.
And its defensive capability was proven during the global financial crisis.
It was. In a retrospective analysis of 56 different screening methods applied during the 2008 financial crisis, the F-score was one of the only strategies that consistently produced positive results. It's the perfect systematic answer to that cheap junk criticism.
Now for the final philosophical critique, which brings this whole deep dive to its head. And it comes from the man who perfected the strategy. Warren Buffett's argument that value investing is, in fact, redundant.
This is where the core logic of investing itself is debated. Buffett argued passionately in his 1992 letter to shareholders that defining value investing as a distinct strategy just causes profound confusion.
Why?
Because it suggests that there are other legitimate forms of investing that aren't based on value.
And what was his conclusion?
He argued, unequivocally, that growth is always a component in the calculation of value. Growth is simply the rate at which the future cash flows of a business will expand. If you ignore growth, you are miscalculating value.
So if you're truly investing,
you are performing a calculation of intrinsic value and buying below it. Therefore, the term value investing is redundant. If you're putting money into assets you believe are overvalued based on their cash flow projections, you're speculating or guessing or consuming, but you are not investing.
And this critique naturally leads to the dismantling of what he calls naive value schemes.
Absolutely. The problem is when investors take Graham's initial concept, low PE, high dividend, and apply it naively, ignoring the fundamental strength of the business.
Take the investor who only screens for a high dividend yield.
Right. They might prefer a declining company paying a high 5% yield over a growing, efficient business that earns twice as much, reinvests half of that for 20% growth, and uses share buybacks for tax-efficient payouts.
They're focusing on a simple, backward-looking metric and entirely missing the wealth compounding strength of the growing business.
Exactly. And Buffett critiques that these naive schemes often lead investors to support older, highly indebted, technologically uncompetitive companies. By definition, if you're selecting stocks based only on those high, simple metrics, you are frequently missing the great, efficient businesses that offer the highest long-term returns.
Finally, we have to acknowledge the ambiguity inherent in the process, which is the flip side of that DCF model. If this is so scientific, why do two sophisticated analysts reach totally different conclusions?
The critique is valid. The method of calculating intrinsic value is not perfectly systematic. As we noted, two analysts can look at the exact same data and reach different intrinsic values because they have different assumptions about growth rates or discount rates in their DCF models.
Which implies there's no single, systematic, universally agreed-upon standard for valuing every stock.
That's right. So success can't just be measured by the method you use, but by the result you achieved.
The ultimate measure of success has to be the excess returns you achieve over the long term, after allowing for all the various risks involved.
The market risk, the specific risks of that industry, and the idiosyncratic risk of the individual security. It just reinforces the idea that investment success is a combination of disciplined methodology and superior judgment in assessing quality and risk.
So to wrap up our deep dive, we've taken this concept of buying a dollar for 50 cents, first formalized by Benjamin Graham and David Dodd, and we've traced its powerful evolution across a century of market cycles.
We established that the foundation rests entirely on the margin of safety, that critical protective buffer against uncertainty, analytical error, and market volatility.
Graham insisted on strict quantifiable metrics, low PE, low PB, low debt, to ensure maximum statistical cheapness.
And we saw how that rigid framework had to adapt to the modern intangible economy, driven by the profound influence of Charlie Munger and the refinement of Warren Buffett. They taught us that true intrinsic value must account for future growth and durable competitive advantages.
Leading to the mantra, buy a great company at a fair price.
And whether you lean toward the rigorous, computer-driven quantitative methods using tools like the Piotrowski F-score to screen for financial health, or the qualitative deep dive methods of a Buffett or a Klarman, the core mission is always identical.
Rigorously calculate intrinsic value and acquire the asset below that calculated figure.
That's it.
So what does all this mean for you, the thoughtful investor who came looking for a shortcut to being well-informed? It means that the true debate in the investing world isn't really between value and growth, as Buffett suggests. That distinction is largely an artificial construct based on simplistic metrics.
The actual existential conflict in finance isn't about style. It's about discipline. The core debate is between discipline analysis, which is investing, and mere guesswork or emotional timing, which is speculation.
And the sources show us that truly great growing companies often look expensive on simple, backward-looking metrics like PE or PB ratios. But because their durable earnings power is so high and predictable, they may actually offer the greatest long-term margin of safety of all.
They are the great company at a fair price.
The question for you to mull over tonight, based on the rigor and the analytical requirements of these legendary practitioners, is this. How much reliance do you place on objective calculation and patience versus hope and short-term market movements?
Which side of that line investing or speculation does your current approach truly fall on?
Food for thought indeed. Thank you for joining us for the deep dive. We'll see you next time.